Happy Friday, everyone. I hope you're having a great start to the new year. I know I am. And you guys already know it's me. I'm Buffy the Rate Slayer, and I have been working hard to get you the most leading and exciting news of the week. So, let's get into it. Welcome to the first episode of our newly launched January 2023 Weekly Market Insight Series, coming directly from the Capital Markets Trading Desk at SunWest Mortgage Company. After a very volatile year that saw equities tumble the most, after the global financial crisis and bonds touching lows due to high inflation and rising interest rates, investors are now waiting on how this year will unfold itself. We all agree that some pressure did ease in the final months of last year as Fed officials started pointing to a less aggressive policy tightening path and as China finally lifted its zero COVID policy. Financial markets did start off this new year with a bang. Equities rallied and U.S. Treasuries headed for their strongest start. But soon after a big launch, the sparks faded as Fed officials reiterated the possibility of a mild recession in the upcoming months. Policymakers emphasized the need to hold rates at an elevated level for quite some time and cautioned against understanding their will to do so. Fed presidents from Atlanta and San Francisco suggested that the central bank could keep rates above 5% for a longer duration. Chairman Jerome Powell mentioned at a conference in Stockholm that restoring price stability requires unpopular decisions. It was evidently a slow start to the week in terms of economic data releases. However, the investors' focus was on the inflation print that was due to be released on Thursday. Figures on CPI were cautiously welcomed by investors as they showed that the pace of inflation has slowed somewhat. U.S. inflation did offer the Fed a room to slow the pace of interest rate hikes next month. The overall CPI fell 0.1% from the prior month, with cheaper energy costs fueling the first decline in more than 2 years. The measure was up 6.5% from a year earlier. The U.S. index futures cheered and bonds rallied as a cooler U.S. inflation report has raised expectations of a dovish pivot by the Federal Reserve this year. So, what else is under the surface? All right. Well, gold extended in advance to an 8-month high as Treasury yields declined after the CPI results yesterday. Moving on, the ISM Manufacturing Survey provided some encouragement by being at 48.4, the lowest reading since April 2020, as it came out largely in line with the expectations. S&P Global U.S. Manufacturing Purchasing Managers Index also fell to 46.2 from 47.7 in November for December. Optimism among U.S. small business owners fell in December to the second lowest level in nearly a decade, as expectations for the economy and earnings fell. The National Federation of Independent Business overall optimism index dropped 2.1 points to 89.8. So let me address the labor market and how it's doing. All right, so the Labor Department said average hourly earnings rose 0.3% last month. Headline hiring of 223,000 was more robust than the expected 200,000. The advance followed a 256,000 gain in November. The unemployment rate fell to 3.5% from 3.6%. Jobless claims continue to show a tight labor market where workers have leverage on wages contributing to inflationary pressures. According to the Labor Department, weekly initial jobless claims fell by 1,000 to 205,000, short of the 215 figures expected, adding to recent evidence of a tight labor market. U.S. job openings remained elevated in November, another component that highlighted a resilient labor market. The number of available positions declined to 10.46 million from 10.51 million a month earlier. So, what else is around the globe? Well, China's central bank reiterated it will implement a targeted and prudent monetary policy this year and will provide support to its domestic demand. European equity indexes rose, with the stock 600 reaching its highest since last April, as traders bet U.S. inflation showed further signs of cooling, a surprise drop in unemployment rate in the region. As per the World Bank report, the world economy is set to experience a sharp slowdown in growth this year due to elevated inflation, increase in interest rates, and disruptions caused by the war in Ukraine. The global economy is expected to expand 1.7% this year, which would be the third weakest growth in nearly 3 decades. Let's now get into how the housing market is doing. U.S. mortgage rates retreated for the first time in 3 weeks, helping provide a modest lift to mortgage activity. The market composite index for mortgage applications increased 1.2% on a seasonally adjusted basis from 1 week earlier. The refinance index rose 5% from the previous week, whereas the purchase index dipped 1% compared to the prior week. Meanwhile, the pending home sales fell for the sixth consecutive month in November, recording a 4% month-over-month drop that resulted in an index reading of 73.9, according to the National Association of Realtors. Okay, so now let's wrap it up. Investors have wounds that are still fresh following last year, which brought the worst year for the stock market since 2008. Undoubtedly, the Fed is now on the path of slowing the pace of rate hikes, with a half percentage point rise in December from 0.75 in November. However, the Fed is still expected to raise interest rates further before completely pausing them. Yesterday's CPI report will be a significant input for the FOMC on February 1st, a report that led investors to speculate if inflation data is kind enough. Will the Fed be persuaded to hike by only 25 basis points in the next policy meeting? Why don't you just join me next week to find out? All right? So until next time, everybody. Before I sign off, I do truly want to wish you a prosperous year. Looking forward to another year filled with great success and new opportunities. Again, please join me next week. I'll have more market updates, figures on various important economic data, an update on the status of geopolitical nervousness, and so much more. So stay updated with our news, and our trading desk will keep you informed with pricing incentives. Have a great weekend, guys. Buffy, out.